Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Kevin Warsh named Fed Chair, The Ultimate Market Guide. Pause. This article was written by Agar Capital. Summary. Kevin Warsh's potential Fed chairmanship signals a paradigm shift toward rapid balance sheet reduction and unconventional cut-and-reduce policy. Markets anticipate a steeper yield curve, higher long-term treasury yields, and increased volatility as Warsh opposes quantitative easing and advocates for less Fed intervention. Warsh's dual stance, dovish on rates but hawkish on inflation and balance sheet, creates uncertainty, prompting risk-off moves in equities, gold, and cryptocurrencies. Institutional independence and Warsh's credibility will be pivotal. Investors should maintain flexible portfolios to navigate potential shifts in liquidity and inflation expectations. Who is Warsh? Kevin Warsh, 55, comes from the financial services industry, Wall Street, and public service. When he was appointed to the Federal Reserve Board at age 34 in 2006, he became the youngest member of the Fed board. Prior to this appointment, he served as an economic advisor to President George W. Bush. To provide some historical context, it is worth noting that throughout his career, Warsh has consistently portrayed himself as an anti-inflation hawk, according to Bloomberg economist Anna Wong. Warsh resigned from the Federal Reserve in 2011 in response to the second round of quantitative easing, QE2, which increased the Fed's balance sheet size. Since then, he has frequently criticized the expansionary Federal Reserve, the Fed's current policy approach, stating that the Fed's balance sheet must be dramatically decreased. In contrast to his previous views, Warsh has recently aligned himself with Trump and called for a decrease in interest rates. As you will recall, Warsh was not appointed to the Federal Reserve Board in 2017, and Trump has referred to him as one of my loyalists regarding his views on monetary policy, while Powell has been subject to criticism by Trump for not lowering interest rates enough. Warsh promises to break the mold. Warsh has attacked the Fed under Powell for exceeding their legal mandate and losing credibility. He states that inflation cannot result solely from strong economic growth or high wages, but rather from excessive fiscal and monetary stimuli. Furthermore, he has advocated for a significant reduction in the Fed's balance sheet, which he believes encourages inflation at this moment. Warsh employs the unconventional cut-and-reduce approach to policymaking, as opposed to the conventional wait-and-see approach employed by Powell. Warsh asserts that there must be a reduction in the size of the balance sheet and a non-interventionist Federal Reserve before he can advocate for lower interest rates, accommodating, to stimulate increased growth in the economy. Powell, on the other hand, has followed an orthodox method in implementing monetary policy. The Federal Reserve has progressively reduced the amount of interest rates available and has used asset purchases as needed. Financial market reaction. The news from Trump was received by financial markets as a risk-off move. Markets priced in a more aggressive future Federal Reserve policy. Long-term U.S. Treasury yields increased. Short-term U.S. Treasury rates declined due to expectations of rate reductions. This resulted in a significant steepening of the yield curve. The 30-year Treasury yield increased 3 basis points, and the 2-year Treasury rate decreased approximately 0.6 basis points during the day. The reactions are consistent with Warsh's description of the Fed's smaller balance sheet, i.e., fewer long-term purchases combined with lower Fed funds. Equity futures moved into the red. All U.S. equity markets dropped immediately. The S&P 500, SPX, dropped 0.7%. The Nasdaq NDX dropped 1%, with sales primarily in the growth sector. The price of cryptocurrencies, which are considered a measure of market liquidity, also dropped. Bitcoin dropped as much as 4% from the news. The dollar did not fluctuate. At the same time, the traditional safe haven assets exhibited uncharacteristic behavior. Both gold and silver dropped significantly. It was obvious, given the volatility at the peaks in both asset classes, that any slightest stumble would have meant a sharp and steep fall. I am honest when I say that I had no doubt about this. The RSI Relative Strength Index of gold reached 90, a level of extremes that has been seen only a few times previously. The news from Warsh simply provided the excuse for the correction of the parabolic price movements that had developed in these markets. In essence, it is another example of a reason that the markets were waiting for to temper the excessive price movement in these markets. Silver dropped by more than 16%, whereas gold plummeted by more than 7%. Gold fell to below $5,000 per ounce. This suggests that Warsh is viewed as a more hawkish candidate, and so the market anticipates a Fed that will cut Fed funds, but compensate with less support for bonds and a tough stance if inflation rises. Macroeconomic and strategic implications. Below, I'll outline what I consider to be the most important things to know from the Warsh candidacy. Number 1, reducing the Federal Reserve's balance sheet. Warsh is extremely against quantitative easing. He has repeated many times that the Federal Reserve shouldn't have a large balance sheet and should not try to influence markets. So, I believe there will be a quickening of the process of reducing the size of the Federal Reserve's balance sheet. Thus, the longer-term premiums for U.S. Treasury debt will increase, since investors will require higher yields for longer-dated treasuries, assuming there will be fewer Fed purchases of these securities. The effects of reduced Fed purchasing can also be seen in the way the markets reacted, higher yields, as I said before. Some of my colleagues on the trading floor have indicated that they believe Warsh has suggested a method of cooperation with the Treasury Department to minimize the effects of the reduced balance sheet. Since less QE leads to more volatility in long-term securities, we may see a structurally steeper yield curve and longer duration risk premia embedded into the interest rates. Number 2, time of cuts and economic growth. I find it odd that Warsh would advocate cutting interest rates, considering his past positions. But it is in line with the Trump administration's policy to create short-term economic stimulus. As such, when Warsh takes office in May, remember, I anticipate he will implement more aggressive interest rate cuts than those anticipated by Powell. Again, I want to point out that Warsh will not have the free rein one might imagine, given that as chairman, he has only one vote on the FOMC and will have to build consensus among the 12 voting members. A strong showing of inflationary pressures in the economy could prevent the majority of the committee from approving overly aggressive cuts in interest rates. On the other hand, I wouldn't rule out Warsh providing a surprise by being more hawkish regarding inflation than previously thought. While it may seem counterintuitive, as Trump's man, this is my consideration, Warsh represents a form of duality, dovish in words regarding nominal interest rates to please Trump and grow the economy, however hawkish in practice regarding budget issues, inflation, and discipline. 3. Institutional independence. The timing of Warsh's appointment is particularly awkward, as Trump has been attacking Mr. Powell for years, and there are already significant fears of political influence being exerted over the Federal Reserve. Many see Mr. Warsh as a Trump supporter. He is married to Jane Lauder, who is the daughter of one of Mr. Trump's largest donors, and the fact that Mr. Warsh publicly expressed support for the cuts that were requested by the White House in 2025 has worried many Fed observers. However, paradoxically, Warsh's very appointment, as someone who is respected by Wall Street and has a long history as an independent hawk, may actually reinforce the perception that there is a credible and independent Fed. In fact, the market response, the dollar rising and gold falling, appears to be a sigh of relief that a competent and somewhat hawkish president is preferable to either an inexperienced politician or someone dependent on political choices. I agree with Mr. Powell's views and comments from the last conference, where he stated that a Fed that loses its independence would become a large and difficult-to-solve problem. Whether this perception holds up will depend on whether Mr. Warsh can prove through his actions that he will put price and market stability ahead of Trump's will. Mr. Warsh's appointment reinvents the way leadership of the Fed is perceived and potentially the fine line between the Fed and the government. Until now, the market had assumed that the Fed was going to cut rates in 2026, 2 cuts. Warsh may change this. If Warsh's actions follow his views, the Fed under Warsh would not be accommodating to another wave of inflation. Warsh has also stated that he believes that Powell made mistakes that led to inflation from 2021 through 2023, and that he wants a change in how the Fed manages price stability. I do think that medium-term inflation expectations have cooled because investors are pricing in a more assertive central bank. This morning's sell-off in gold and inflation-linked assets is a first indicator of this. Much will depend upon whether Warsh can establish credibility. If the market perceives even the slightest indication that there will be a political flip-flop, i.e., too many cuts before an election, then inflation and political risk premium will increase very quickly again. My view: Kevin Warsh's inauguration heralds a new paradigm for markets. A chairman who represents a middle ground between a true reformer and a traditional politician presents an opportunity for investors to reconsider their investment strategies. In the short term, investors have reacted by selling long-dated bonds, reducing their exposure to equities, and hedging their bets on a less expansionary Fed. However, as we move into the medium term, there are many questions remaining about how this new paradigm will play out. Will Warsh's leadership help restore credibility at the Federal Reserve regarding its anti-inflationary goals and thus lower price expectations? Or will his unconventional approach to managing monetary policy, i.e., shrinking the size of the balance sheet, aggressive cuts, and coordinated efforts with the Treasury, create such great uncertainty among investors that they require even greater risk premiums to invest in these assets? The ability to strike a balance between Trump's desire for short-term stimulus and the long-term stability needed to maintain the confidence of investors will be critical to success. I recommend that investors consider preparing flexible investment portfolios capable of addressing both of these possible outcomes. As we enter a transitional period in the economy, available liquidity will be my magic word for 2026. As the Warsh experience demonstrates, paradigms can change rapidly, and the market is simply waiting for another Fed chairman to put through the paces. This article was written by Agar.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.